All right, startup funding in 10 minutes. If you're trying to raise money right now, you've probably already gone down the YouTube rabbit hole. You've seen the 45-minute lectures, you've seen VCs talking with buzzwords, and people trying to sell you a course before they actually tell you anything useful at all. And look, this isn't that. I'm going to actually give you the clean, no bullshit breakdown of how startup funding really works. From bootstrapping to VCs to private equity, what investors actually care about, and how to think about money the right way. So give me 10 minutes and you'll understand the funding game better than 90% of founders out there. Quick context so you know where this is coming from. Look, I've raised tens of millions of dollars for my own companies. My partners and I, we have raised over $1 billion for other people's companies. And look, I'm licensed. This is what I do every day. This is what my firm does every day. We raise money. And I've sat in rooms with everyone, from people writing $25,000 checks to sovereign wealth funds, princes in Dubai writing hundreds of millions of dollars in checks. So what I'm walking you through today isn't some garbage, some BS garbage. This is a real playbook founders use right now to actually get funded, the one that actually works today. So let's start with stage one, where everyone really starts. Bootstrapping, friends, and family. This is the scrappy phase. This is savings, your credit cards, maybe even small checks from uncles and aunts who believe in you, which I don't ever recommend you do. And here's the truth. Investors don't care about this stage, but you should, because this is where you prove you can execute with almost nothing. Look, if you can't create momentum with a few $1,000s in your pocket, no investor in the world is going to trust you with a few $100,000 or more. Look, here's a pro tip. Never ask friends or family for money without a clear plan. I don't like asking friends or family at all. I love friends of friends, that's fine, but friends and family gets very dirty if and when things don't go right. But if you can say things like, hey, I'm raising $20,000 to build an MVP that'll get me X amount of users and I'll have X amount of revenue, and that's when I'll start raising a seed round. If you can be very clear and concise like that, that clarity will start to build trust and makes them feel like they're investing in progress and not gambling on some hope. Next up is angels, angel investors. You all have heard that word before. These are typically high net worth individuals who like to back early founders. They could be ex-founders themselves, successful executives, or just wealthy people who love the thrill of early stage deals. And look, angels usually write checks from $10,000 to $250,000, maybe a little bit more. But now here's what actually matters. Angels invest in the story more than they invest in spreadsheets. They don't care about your 5-year projections at all. They care about your conviction. They care about your timing. They're investing in you, whether you can make them believe you're building something awesome. So when you pitch an angel, forget the corporate garbage, the corporate language, trying to sound smart. Tell them why you're obsessed with the problem, why right now is the actual window, and why you're the one who's actually going to make this happen. Make them feel early, because that's what they're buying. The chance to say, hey, I got in this before the world actually knew what this even was. Stage 3 is seed funding. This usually is your first institutional raise. You're talking to early stage venture capital funds, micro venture capital funds, syndicates, or maybe even super angel investors that will have a lot more capital or pull capital together. And rounds can range anywhere between $500,000 up to $3 million, depending on the traction you have and the market size of the niche that you're in. And at this stage, investors are looking for proof. They're not looking for perfection. No one's looking for perfection. You don't need millions of dollars in revenue right now, but what you do need is momentum. And that could look like this. It could look like early users or paying customers you may have, signed LOIs or some pre-orders you might have, strong engagement data that you have, any press, do you have any press, partnerships that you may have, or anything that shows demand. Look, seed investors want evidence that your idea is working in the real world. So here's a pro tip when looking for seed investors. Don't show up to a seed meeting with only an idea and a deck. You will not get funded. You need to show evidence that people want what you're actually building. Even a small pilot, a small amount of people can change your entire evaluation and the entire conversation when you're talking to seed investors. Okay, stage 4. Series A rounds and above. This is where things actually start getting really, really serious. Typical raises are between $3 million up to $15 million for an actual Series A round, and then it just keeps scaling from there. Series B, Series C, Series D, all the way up. You've proven your product, you've proven the market fit of your product, you have revenue, you have growth, you have data, and investors at this stage aren't betting so much on your idea anymore. They're betting on your execution. And they're asking things like, can you scale efficiently? Is your team built to grow quick and fast. And what's your moat? What separates you from everyone else in the market? Every round from here on out is about pouring gas on the fire, scaling what's already actually working. So your job is not to convince them that the idea works at this point anymore. It's to prove you can scale it. It's to prove you can go faster with more money, and you can be smarter than anyone else in the market. So let me make this really clear, because founders mix this up all the time. Here's who's writing checks at every single level. Friends and family, look, they invest in you. They believe in your drive, in your vision, in your mission, and they're investing in you. Angel investors are investing in your story. They want to feel early. They're trying to be early to get a hopefully really big reward at the end, but they're also investing in you. So they're investing in you and your story. Seed funds are investing in traction. They want to see momentum. They want to see traction. They want to see real things happening. Doesn't mean you need to have millions of dollars in sales. That's not what we're saying. But you need to have some type of actual momentum. And then Series A and above are investing in scale. They want systems. They want processes. They want teams. They want growth. They want to see that their money can be returned, and be returned in a really good and precise time frame. Why is this so important? Look, if you pitch the wrong people, and so many people do, if you pitch the wrong people at the wrong stage, you're going to get ghosted. You will never raise $1. You're not going to bring a napkin sketch to a Series A or VC, and you're not going to bring a 40-page pro forma to your cousin to try to raise capital. You have to match the pitch to the actual person. All right, so now this is a part that almost no one talks about, because the real situation when it comes to actually raising money is that raising money and funding, it's not free money. It's fuel. And like fuel, if you burn it inefficiently, you're going to crash and you're going to run out of it. So here's how to actually start thinking about money. Look, every round of capital should buy you more time and more progress. You need to be asking yourselves, what milestones do I need to hit in the next 12 to 18 months that actually makes me 10 times more fundable than ever before? And those milestones could be things like hitting $100,000 in monthly revenue, having X amount of users, 10,000, 20,000 users, having some regulatory approval, maybe having a signed contract, a signed distribution deal. That's always huge. And then go raise enough to hit those milestones and give yourself a small buffer, some actual working capital. That's how the best founders think. They don't raise money just to survive. If you're raising to survive, you will never raise any capital at all, because why would someone give you a check? They know that you're going to burn it. They raise money to gain more leverage in the market. Okay, quick side note on all of this though. Look, you have to figure out where you are, because not every business needs equity funding. There are many alternatives and many alternative capital paths that you can have that might be smarter, even a debt round. You can get debt financing, which can be lines of credits, which can be SBA loans, which can be revenue-based financing. Banks will lend to you based upon the revenue that you may have in your business right now. You can keep your equity, and then you just have to make a repayment, a debt payment. It's really great for businesses with cash flow, because you can go get lending on that, and then you're not giving up equity to an actual investor. What about strategic investors? Those are my favorites. Strategic investors are incredible. They're corporates that invest in because your product helps them and they help you. They often bring distribution channels, they bring more credibility, they can help you grow a lot faster. Strategic investors and strategic money is huge at every stage of the game. If you're new, you can get grants. Free money, if you actually qualify, you can get government grants, innovation grants, or research-based grants. It's a lot slower, it takes longer, but again, you're not diluting yourself of equity long term. And then you can also look at crowdfunding. Not my favorite, but hey, it does work for a lot of people. It has equity or reward-based campaigns that double as marketing and sales start to increase. Look, the best founders stack these strategically. They don't just take one, they take multiple, using the right tool at the right time. If you are a business that has cash flow, a little bit of equity, and a lot of debt, could be a really good option for you. If you're a business that's just starting up with no cash flow, well, yes, you're going to look at a lot more equity type transactions for your business to start growing. I had a founder come to me once and they were trying to raise about $5 million at a seed round. The problem is they had no traction whatsoever. And I told him, I said, you don't need $5 million right now. Matter of fact, you just need proof right now. So we changed his plan and we ended up raising a smaller amount. We raised $750,000 and he got 3 large customers from that and built real demand. And then what he did is 18 months later, he started raising more capital. He raised about 6.8, almost $7 million from top investors, really high net worth people. And he got a much higher valuation out of his company at that time because he had the right money at the right stage with the right story. He had some more traction. So The recap to all of this is, if you're early on, you're bootstrapping, yes, you're looking at friends, families, angel investors. If you have traction, you have real traction, you will look at a seed round. And if, look, you're ready to scale, that's when VCs step in, maybe some private equity, depending on where you are, super high net worth, family offices, people like that start to step in when you actually are ready to start scaling. And along the way, don't be stuck on just equity. Consider debt, consider grants, consider the right strategic partnerships to keep your equity and your cap table super clean. Because raising money is not about chasing everyone with a checkbook. It's about finding alignment, finding the right money, finding the right capital at the right time for the right reason. Get that right, and you won't just raise money. You won't just raise capital. You'll raise it on your terms, and you'll see your business start to thrive.